You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Hello, thank you for coming on the podcast. Today we have Taylor Avakian with the group CRE. Taylor, thank you for joining me.
Cam, excited to be here.
In the commercial industry, what we're facing today, what we've been through, tell us a little bit about yourself, your background.
Yeah, of course. So I'm a commercial real estate broker. I specialize in the sale of apartment buildings here in Los Angeles and been doing this since 2018. So we've seen a lot change, specifically in the past 18 months when rates really started climbing up. I remember when I first started out, it was tough. The first year of any brokerage business, right? You're trying to kind of get your legs underneath you, get people to know you, understand what a cap rate is, all that fun stuff. But there was, once you got a listing, you're pretty confident you're going to sell it. The listing was the hard part. Now in today's market, it's like we're turning down listings left and right because the price expectations are just not in line with the market right now. It's very much still a buyer's market. And over the last 18 months, it's been much more of a proactive brokerage approach to go and I got to go find the right person. It's really a needle in a haystack kind of situation. And there's a lot of headwinds that we're facing from an apartment perspective in LA with regulations and new government changes, the elections coming up here in November. So it's been interesting to see, but yeah, I've been working with apartment owners in LA for the last 6 years now.
So in terms of pre-COVID and during COVID and post-COVID, how did the dynamics change and the expectations from a buyer versus a seller?
So I don't know if COVID affected things in terms of expectations from COVID itself. However, what COVID really did was when there was a pause in the market, there was a ton of pent-up demand. And I think once the Fed crushed the interest rates to zero, basically, people were buying things left and right at ridiculous cap rates that just really are, when you think about it, don't really make a ton of sense, don't give you a bunch of leeway in terms of if things change or the volatility of the market. And what even got worse or rebounded from that was how quickly that the interest rates actually jumped up, fastest, I think, in history. And so the dynamics have changed more in the last 18 months than I think previously in terms of before it was we'd send a property out to market, right? We'd list it, we'd get 30 inquiries and 15 people submitting offers, right? Some of them were low, some of them were high, some of them were in the ballgame of us, let's negotiate. Now we send out first email blast, social media blast, video, like everything. And even then, we're not guaranteed to get some sort of offer or interest or anything. I got to pick up the phone and start calling these people who I built relationships with or who I know portfolio might fit this. It's very much get after it kind of situation from a broker's perspective. And I feel like right now buyers have much more power in negotiations because there's not that competition, which as a broker, as you know, our whole job is to create competition. It's to get as many people interested in this property as possible and to get them to pay the price that they have to pay, not the price that they want to pay. So that's really the dynamic that I've seen change over the last couple years now. And so it's interesting to see we're on the precipice of hopefully some rate cuts that are going to be coming soon. Hopefully. So I think a lot of people are excited to see what happens. That we have the election coming up, which humans are, for whatever reason, the level of uncertainty that happens in an election year, right? They just pause. They're like on the back heels and they don't want to do anything. Even if the fundamentals don't change, which is interesting to me. I think the biggest thing in LA for multifamily is this Prop 33 and some of these propositions that are on the board that could really affect just the fundamentals of how you invest in real estate, what kinds of real estate makes sense to invest and put risk in, because everything's a calculation of risk when it comes to investments, and the cap rates that you pay are associated with that level of risk. And if things swing one direction or the other, that risk is going to change. And so I think people are waiting to figure out and see what actually occurs in that election, and that'll determine the direction that the investment vehicle or the investment strategy that a lot of the current investors do in Los Angeles, how they look at deals.
You mentioned these buyers that bought at these low cap rates, right? When the interest rates were low. What do you see happening with their properties today?
In terms of value?
In terms of value, in terms of if they have a loan that has to be refinanced, is it a balloon payment? When they're refinanced, do you have to put more money into it? Or do you get those calls, or I need to sell this property, otherwise I can't refinance it?
Yeah, definitely a lot more cash and refis than I've ever seen before. The distress market is an interesting place right now because it doesn't feel like it's real distress in terms of 2008, 2009, 2010. Like, I wasn't in the business at that time, but from people who were and people that I've spoken to, right, it was like the banks were taking back everything and they were just selling them pennies on the dollar. That's not what we're seeing today. And what's interesting in my market is the rise of these private debt funds really has skyrocketed. And a lot of these private debt funds are structured in a way where they have almost like an asset management division within them. And so they have the perception that they can repurpose or restructure the asset or hold out long enough to wait for prices to get to a level that's above their basis or par for them. And so they're not selling these assets at a discount. They're waiting and holding on and figuring out what it is. And a lot of my clients who are buying at low cap rates or who bought at low cap rates either are in a position where they have good investors who recognize the fact that it's not a good time to sell in this market if you don't have to sell, or there isn't a better opportunity for you to exchange into. If there's a better exchange opportunity or you're losing faith in the location or the real estate that you have, then of course, go ahead, right? Because it's just you're moving money from one asset to something you feel is stronger or a location you feel is stronger. But in terms of pure distress, and even people who bought cap rates at 3%, and now interest rates are 6.25%, they're holding on. And Los Angeles is a unique place in that most of the owners are mom and pop, and so they don't have IRR returns to hit. They don't have metrics that they have to hit. So if they bought a property at a 3 cap and they haven't been able to increase the rents very much, it's like they were never going to sell anyways. They're riding it out and, putting money in if they have to. But we're helping clients who are in positions where they have to restructure and figure out new ways to get to a place where they're not having to put so much money in. But it's unique. It's interesting to see. I mean, from your perspective, are you seeing a lot of clients having to figure that out?
A lot of the clients I'm seeing, that the majority of the calls I'm getting today are, yes, when we come to refinance them, because typically it's a balloon payment of what they have to put a lot of money in. I've seen, $500,000. We saw a deal a month ago about $8 million that's coming out of pocket.
Oh gosh.
So, and they're telling me, what other ways do you have? I'm like, there is no other way. It's what's the bank's call at this point,
Yeah, you're beholden to the bank. Right?
Yeah.
You don't really own your property. The bank owns your property,
right?
Depending on...
And even on the private equity side, which you were mentioning, they're not willing to touch it at times.
Yeah.
They have their own portfolio, their own issues with their current borrowers. So it's like a catch-22 for them. What do we do?
Yeah.
In the instance, if it's a non-recourse, they have a little bit of leeway. There's no personal guarantee. But if there's a personal guarantee aspect of it, they really have to make up their minds wisely and speak to their lawyers and accountants.
Did you see a lot of loans that were being done over the last 5 years? Were the primary of them personal guarantee loans, or were they non-recourse?
I would say about 60 to 65% were personal guarantee and about 35% were non-recourse.
Okay. If you buying real estate, would you ever do a PG loan?
I would always do non-recourse if I have the option to.
Yeah. And typically, what's the difference between a non-recourse and, are you paying a premium in terms of points? 0.2
to 0.4 to 0.5 higher on pricing.
Okay.
But when the rates were in the 2s and the 3s, that really didn't matter. But people wanted still the lower rates, and I told them, I advised them, I would firstly go with their non-recourse, but at the end of the day, it's your call.
Yeah.
And now they're all calling me back and telling me, why didn't I do that?
And it's super interesting too, because I was listening to a podcast too, and they were talking about the difference between floating rate and fixed rate. And anyone who got a fixed rate loan in 2020 to 2022, you were like, wait, why are you getting a fixed rate loan? because if you've looked at the historical returns of what actually produces a better return, floating rate, 95% of the time, you get a better return on your money. Right. But in the instance where the interest rates jump up like they did, then you're screwed. And so it's interesting. I'm curious to know right now, with kind of the pain people felt not getting a fixed rate loan, do you find more borrowers choosing the fixed rate route today, even though they feel like rates are going to be coming down, or have they been scarred by what happened?
They've been scarred by what happened, and majority of people want the floating rates or the shortest fixed rates, the 3 or the 5s.
Okay.
But what the banks are pushing today, it's very interesting, right? So if you get the swap rate loans are the very unique ones, right? Mm-hmm. People who got them in the 2s and 3s, and when they come to refinance and the rates were in the 6 and 7s, they made money. One client made $800,000 when they refinanced because of the swap that he had.
Can you explain that to me? What is a swap debt?
So swap debt is basically, let's say, for instance, if you get a loan today that's 5.5 and you get a 5-year fixed, right? In 5 years, if the rate at that time is higher, when you go to refinance, the bank will pay you to get a loan. But if the bank is if the rates are lower in 5 years, you're gonna have to pay a prepayment penalty to get out of that loan.
Interesting. And what is when you're deciding between a swap loan or not, do you pay a premium for the swap? Do you pay?
No, it's always a little bit lower rate, up to a 0.5% lower rate. So what the banks I'm seeing today are doing, they're trying to get people into these swap rates, right? To protect themselves. But everybody knows, or hopefully the rates are going to come in a downward trend.
Yeah.
How much lower they're going to go, we don't know. But so I'm, again, I tell my clients, this is going with a conventional, with a swap. This is the issues. I would, again, advise to speak to your attorney, to your CPA, see what's most advantageous for you.
Yeah, right now, I don't think a swap would make sense. But it's interesting how it's almost like a financial hedge, because if you think the rates are going to go up, then you actually benefit from that scenario. So you're like hedging, which is so cool. There's so many financial vehicles that we don't have to deal with, because most of the loans that are done are by traditional big banks, and Chase being one of the biggest lenders for multifamily in Los Angeles, and it's very standard. But some of the financial vehicles people do, taking options or futures contracts on certain, I've heard crazy stuff in the institutional space, which is way above my pay grade, but you can financially engineer a ton with the way that you structure loans and buy, future, it's pretty intense once you really dig into the weeds of it.
Right. Well, in the deals they did, the bigger deals, were there a lot of CMBS deals and CMBS loans involved on your multifamilies?
Yeah, so most of the CMBS debt that was taken out for multifamily in Los Angeles are these bigger institutional properties and buildings, and so yes, there were a few of them, and those are typically publicly available, so you can see who. What were the groups that were taking out those big ones? But from a majority perspective, 85-90%, if not more, were just conventional loans. But I think those CMBS loans and debt, those are the ones who are having to make a pretty strong, intense decision right now. That's a great word for it. It's like, okay, what do we do? Do we keep our reputation? Do we work it out with the bank? Do we kick the can on the road? Do we raise more money, and do those metrics make sense? Do I have enough equity as a GP partner in this to do it? And then you have to decide, okay, do I want to keep my reputation, or do I want to make my investors money? Or it's a kind of a toss-up in today's market. And I think from my perspective, it's starting to loosen up a little bit, because for a long time, people were they thought rates were going to come down sooner than they have. And so they were hoping things would change, and it looks like right now that's not going to be the case for the foreseeable future. So they have to make a decision. They have to refinance, sell.
No choice.
There's no choice anymore. They were hoping, kicking the can down the road. There's no more. It doesn't feel like there's any more kicking that can.
You mentioned a little bit about the ballots, about the new laws and regulations coming up on the ballots. Can we discuss those a little bit further, and what you think it's going to affect the multifamily if they do get passed?
Yeah, from a local perspective, the biggest one, California, is something called Prop 33. And what Prop 33 is basically the repeal of this law that's been in place since the 90s, which is Costa-Hawkins. And what that law did was it put barriers on what local governments could do in terms of the strictness of rent control and what they could do in terms of changing how much you could increase the rents or not increase the rents. And what that Prop 33 is doing is basically allowing local governments to create their own rent control laws at the whatever level they see fit. And so what the fear is that if Prop 33 goes through and passes and repeals the Costa-Hawkins, then what happened in New York in 2019 with vacancy control, that would happen in a lot of cities in Los Angeles and Southern California and California in general, Santa Monica, places where they're historically more pro-tenant, I guess you'd say, which I have my own opinions on rent control and I actually think that's pro-tenant. But what the big issue is imagine, let's say you have a 10-unit apartment building and each tenant is paying $1,000. If the market rate rent for those one bedrooms is $2,000, if Prop 33 passes and they enact vacancy control, the government can say, instead of raising that $1,000 to $2,000, which you can do today, renovating the unit, renting it out to a new tenant, we're only going to allow you to increase the rent 3%. So you're going to be able to increase the rent $30. No one in their right mind is going to take on the risk, especially if the cap rate's less, lower than what the risk return is from treasury bills or anything like that. No one's going to buy a 3 cap because it's going to take 50 years to be able to get to a place where you can get the returns that make the most sense. And so it's going to be interesting to see if that does pass, what that's going to do to cap rates. In New York City, I mean, they have more vacancies than I think they've ever had before, just because it doesn't make financial sense to fix up the units and even rent them out. They just hold them off of the market because why would you spend 20 grand to fix up a unit? You can only get $30 more. And it doesn't make any sense. So I think in practice, right, short-term, they feel like the short-term gain is worth the long-term. I don't feel like it's actually going to benefit the way that they would hope it to. And I think we're seeing that in New York City as well. It's not having the effect that they're hoping it will have in terms of keeping rents lower. The solution, in my opinion, is supply. Increase the supply. There's more, it's an economics factor from that perspective. So that's one of the bigger bills that have been talked about pretty heavily amongst apartment owners, investors, brokers, is see what happens with Prop 33. And there's a ton of money being raised for it. And we're gonna see if in the next 4 months my business model changes completely, and all the investors in LA's business model changes as well.
Absolutely. That's going to be pretty much lower cap rates is pretty much parking money. But if that passes, you're parking your money twice.
Yeah, exactly.
Thing in that nature.
Right. It's just like, I don't know. The opportunity cost would not make a ton of sense to invest in Los Angeles multifamily compared to any other market, because even if things are more difficult to manage or run, it's just the risk reward doesn't make sense.
Absolutely. Is there anything else you would like viewers to know about yourself? What's gonna,
Yeah, I think it's gonna be interesting to see. A lot of my conversations with owners right now is, how do you prepare for the unknown? Because as an apartment owner, as someone who provides housing, as a real estate investor, there's a lot of things that are outside of your control. And so what can you do that is in your control to set yourself up to be the best operator and owner and investor in these assets and real estate? And so I think having a different perspective, looking at your options, knowing the regulations, working with a specialist who spends their whole time literally just trying to learn knowledge to help their clients better. It's very important to find someone who aligns with your goals and understands your goals, because as investors, right, we have different goals. Not everyone wants to maximize their returns. Not everyone was chasing an IRR. Not everyone has plans to hold on to these properties forever. And so understanding your business plan, understanding what your goals are for investing is super important. And then being able to align yourself and have the network to go to different places to figure out the answers to your problems, I think has been super, super helpful for the clients who've performed the best and who've done the best, and the ones that I like to work with. That's what I think for myself, I really try to hone in on as a skill set is, okay, what knowledge and connections and people and skills can I have to better serve my clients, where at the end of the day, and this is something I heard someone say, it's what would make someone feel silly not working with you? That is my goal, is everything that the lens I look through, how can I make the client experience better where they would feel silly working with anyone else but me? So I've really enjoyed that process. I've started a podcast as well. We're coming up with a name right now, so we'll see what that's like. And I'm actually recording it in the studio too. So thank you for letting me do that. But that's been really fun too. I'd actually be curious, if you don't mind, how has social media changed your business? And do you think that as real estate, which is typically an older kind of business, do you feel like social media has finally been able to make its way through in the commercial space?
I think what the social media does is make the cold leads warmer leads, because social media is, I think, is an avenue of giving out information to make consumers and to just make the general public feel comfortable and just see what's available out there before they have to go speak to people like yourself, myself, and other get all this information. But there's a lot of, if you're able to give them the information, make them feel comfortable, at that point it's going to be personality and customer service that's going to bring them along to you.
Why do you think your clients choose to work with you?
It's mainly of referrals and the customer service aspect. And
what
just delivering what I say.
What makes a good customer service experience from your side of things, from a broker's perspective, or from what you do?
Basically, from the day you meet, whatever you tell them, you do within a timely fashion, and replying to calls and emails within 12 hours, max 24 hours. And always being there to answer the questions at all times. We don't have any days off. We work 25 hours in 8 days a week.
How do you balance that?
It's honestly, there's no balancing. You just have to do what you have to do.
Yeah. I mean, the people who you've seen do the best in this business, and from an investor perspective and from a broker's perspective, are there any commonalities that they have that you think separates them from the ones who are just so-so?
It's the customer service and being, honestly, being on point, delivering what you say is the most important key.
Yeah. Doing what you say in a timely fashion with the right values. Correct. and understanding what someone's goals are.
Correct. Absolutely.
Right. Knowing, because again, you got to treat every client situation differently.
Correct.
And being able to do that the right way.
Yeah. Some have more knowledge where it's, might be easier. Some have little knowledge, where it's that first building they're buying. So you have to babysit them and hold their hands from A to Z.
Yeah, this is a fun business to be in. There's definitely ups and downs, but I think exploring different avenues and trying to find ways that we can improve the client experience. And it's so key. It's just such a good key to be on. Moving. Right? Yeah. I know. I wake up every day and I'm like, shoot, okay, another day. What fires do I got to put out? Correct. Who can I help? Who can I get, meet new and try to make a win-win-win scenario. Because at the end of the day, we want everyone to feel like they're winning. Yeah.
All right. Well, thank you for being on the show, Taylor. Look forward to future many more deals.
Cam, I appreciate it. Thank you for having me.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's